Today we are going to do the revenue recognition as per US GAAP ASC 606. So revenue recognition provides a single comprehensive revenue recognition models for all contracts with customer to improve the comparability across the industries, jurisdiction and capital market. This is the objective for revenue recognition. Now coming to the principle. The principle of revenue recognition is to recognize revenue in the accounting period. So here the important term is the accounting period. So it actually protect you for overbooking or underbooking of revenue. So revenue recognition helps here. So in which the performance obligation is being performed or satisfied. A performance obligation is satisfied when customer obtain the control of the asset and the asset is good or services transferred to the customers. So it means that once you finish the transfer, it means you deliver the risk and reward related to the asset to the customer. So the moment you finish the transfer of the control from buyer to the customer, so in that case you actually you already perform your obligations. Then now you can recognize your revenue. So here is an approach. So revenue recognition is a principle based approach rather than rule based. So when you say the principle, it means that in revenue recognition you are going to utilize your professional judgments, your knowledge, your experience. And the good thing is that whatever you are applying, you have to apply consistently. It is not like one time this method, another time this methods. So even though it is a principle based, but has to be applied across or within the company uniformly. So no one person can decide, or no one unit or the department of organizations will decide how to do the revenue recognitions. Now there is a first approach is called contract asset and liability approach. So when you say the contract asset and liability approach, this model is based on the asset and liability approach that recognize the revenue based on the change of control of asset and liability. So here there is a two type of asset, contract asset. One is the conditional, another is the unconditional. Unconditional means once you deliver the goods or control to the customer, no further obligation is to be performed. In that case, it is an unconditional transfer. When you do the unconditional transfer, you immediately recognize the revenue. It means that you do the AR debit and credit is the sales revenue. And since here I will just discuss something called inventory management for the perpetual and the periodic. When you do the periodic, you need to do the physically stock take at the end of the period. But if you are doing the perpetual method, so it is like an auto expensing of the inventory. So here once you do the revenue booking, the same time your system will pass the cost of goods sold entry. So cost of goods sold debit and inventory will be credited. It means that whatever the inventory you had, it will be reduced and it will goes to the P&L accounts through the cost of goods sold. Now coming to the conditional asset, it means that you have performed the obligations, but only one obligations or some obligation, few obligations, but still there are some things is to be performed. So in that case, if you have already, so in that case you need to recognize the revenue through the contract asset. So now your entry will be contract asset account debit to revenue, and then once you invoice it, then what will happen? You can recognize the revenue once your obligations are satisfied. So in this case, debit contract asset, credit sales revenue. Once you are invoicing, then in that case the AR debit to contract asset. So in that case again for the cost of goods sold entry will remain same, because here it is assumed that you are doing the perpetual accounting, perpetual inventory management. Now coming to the contract liability, if you have received some money in advance, then in that case it is like it is the you are in liability to perform, like and still you have not performed any of your performance obligations. So once you perform, then only your liability will convert into the asset, convert into the, you will square off against the revenue. So first you are, once you are receiving the cash, so you will do the cash debit or bank debit, with in any form you can receive, either in form of cash or bank. So once you receive the cash or bank, then you will say that cash or bank debit and credit is your contract liability. It means it is a sort of advance from customer. So it is until you perform your obligations, till that time it is a liability for you. You need to record in the current liability side of the balance sheet. So once you receive the cash, it means that cash debit to current liability, contract liability. The moment you perform your performance obligations, it means you deliver your part, okay, then only you can do the contract liability to revenue. Now you are squaring up your liability and booking your revenue. Now again, the cost of goods sold to inventory, because we are assuming that we are doing the perpetual account, perpetual way of inventory management. So in that case, again your cost of goods sold will be debited to the inventory. Now you are reducing your inventory and booking to the cost to the P&L. So this is there is another approach is called the 5-step of revenue recognition. So in the 5-step of revenue recognition, what you are doing, first step you need to identify your contract with the customer. The second step is to identify the separate performance obligation in the contract. It means the contract should have a separate performance obligation. Then determine the transaction value, like what is the price you are going to charge. This is called the transaction value. Then allocate the transaction price to the separate obligation. It means if your price is able to allocate to a separate, if you have one or more performance obligation, then you should able to allocate your revenue or your considerations against the each performance obligations. Then the last is recognize revenue when or as each performance obligation is the moment you are delivering or you are fulfilling your obligations. That same moment you can start recognizing your revenue. So here these are like two way of doing the revenue. Like I said, then we will do some practical in the next session. Stay tuned. और अगर आपको कुछ भी समझ, इफ़ यू वांट टू नो मोर और कुछ भी अलग से समझना है, तो आप प्लीज़ यू कैन कॉन्टैक्ट अस. थैंक यू वेरी मच.